take action. Like, you just need to take action. It's not always an easy thing. So what I'm telling people is, look, you're not always going to feel comfortable. You're not going to feel safe. You're going to feel like you're sticking your neck out there. It's going to be scary. All those things, right, that stop you from taking action. And you just have to be able to live with the fact that you're going to maybe have to be uncomfortable for a minute and just go for it.
Welcome to the Boise REIN Show, your destination for creating wealth through connections in real estate and business. Are you looking to become a real estate professional? Do you want to start your own successful real estate business? Well, I'm your host, Matt Osojnicki. Join us as we learn from the brightest minds, industry leaders, and experienced professionals, equipping you with the knowledge and confidence needed to make informed decisions and thrive in the ever-changing real estate landscape. Your journey starts now. Welcome back to the Boise REIN Show. I'm your host, Matt Osojnicki, and today Grant Porter has joined us from Bluebird Home Loans to talk about mortgage rates, interest rates, and all those data details that we all want to know when, closing a loan traditionally speaking. I'm very excited to have him on. He's going to be a wealth of knowledge to all of us. He already has. He does webinars for the Boise REIN all the time, and he just loves giving back. And today he has given some time to speak with you guys. So without further ado, he's been a loan officer for over 20 years. He owns a whitewater rafting company, which is freaking awesome. He's owned a FedEx company, and he also owns real estate. There's probably some things I'm also forgetting, Grant, but if you don't mind, just bring the audience up to speed a little bit about where you came from and where you got to where you are today.
Sure thing. Thanks a lot, Matt. So where I came from, well, wow, how far back should we go here? Born and raised in Twin Falls, Idaho, so Idahoan.
Nice.
The only one in my family, but I'm the youngest. And then I went to the College of Idaho, and when I finished up at the College of Idaho, I ended up in Boise. So that fast-tracked about 19 years right there. At that point, I didn't really know what I wanted to do, although I had grown up in the whitewater rafting business. And so my parents had started this company. It was a side business for them in 1980. So I was 5 years old. And so I kind of grew up in that whitewater world up in Stanley. And then after college, during college, during high school, I was a guide on the Middle Fork, and that was my summer job. And so I always loved that world. But then I had to start thinking about, okay, what I really want to do with my life, right?
I'm an adult now. What do I want to do? I know how those college years go. You're like, okay, I'm going to school, but what is it I'm going to do?
Yeah, totally. Yeah. And in college, I studied biology. I studied psychology. I thought I wanted to go to med school at one point. And so I was on this kind of med school path. And immediately I realized, you know what? I looked around at those who were getting into med school, and I was like, I don't think I have the discipline for this. There were some super smart kids that were really competitive and really driven. And so I was like, gosh, I'm not there yet. And so I kind of shifted and got into some Spanish and traveled a little bit, and then got out of college and was like, okay, what am I going to do? And my parents were like, hey, we're going to sell this rafting company unless you want to take it over for a while. So I started managing that. And at that point, I still didn't know. It's a seasonal thing. So I managed that and was like, I got to find another job in the off season. And that's where the FedEx business kind of came into play. And so my wife was into pharmaceuticals sales, not into pharmaceuticals. Mm-hmm. She was into pharmaceutical sales. But anyway, there was a guy delivering packages one day at our house, and he was talking to me about his FedEx route. And he was like, I'm going to sell this thing and get out of it. And I was like, sell it? How's that work? So I got to talking to the guy. Anyway, we bought this FedEx route, and it was FedEx home delivery at the time. And so I had this FedEx route, and in the summer I would go take off and run the Middle Fork. And I was the manager of that company. And then I have a brother who's closest to me in age. He's 4 years older. And then our oldest brother, his wife, had started a mortgage company. And they were in the mortgage business already. So she started it in 1994. My older brother jumped in there in 97, and I was just graduating from college. And then I started doing my FedEx and my rafting thing. And they were like, hey, you'd be crazy not to get into this business. So it was my sister-in-law and my brother who talked me into getting in the mortgage business.
It's amazing where your path can take you when you just go out and do things.
Yeah.
Like, oh, well, mom and dad, I've never had experience running an entire company rafting, but I love rafting, so let's give it a shot. Like, let me take massive action and see what happens.
Totally. It was scary. I was like, I don't know if I really want to do this. And I was just like, I don't know. Let's just try it out.
And the FedEx route, was it just you running the route?
Yeah, it was me running the route. And then I started hiring people to run it for me because I was like, I don't know if I want to do this forever. Plus, I kind of was just trying to turn it into a little bit of a passive income thing.
Sure.
And so I hired someone because I needed to when I was rafting. So I was gone all summer. So I had to have someone. And then it turned into, okay, I'm just going to have someone else run it. I'll own it. And then, then I ended up getting in the mortgage business. So I overlapped all three of those at one point. So I had all three kind of going.
Wow.
But the FedEx thing, I quickly realized I didn't want to have to manage that anymore.
Yeah. I don't know what it looked like as a, 20-year-old?
Yeah. I was 21. 22. Yeah.
To understand like opportunity costs at that point. It's like, well, what am I good at? When do I have some free time?
Right.
So you got into the mortgage field.
Yeah, the mortgage business. So that was just lucky that my brother and my sister-in-law were in the business, and she owned the company, and she was like, look, you'd be crazy not to get in here. And so I jumped in. She was actually on bed rest and was pregnant with twins. And so she needed help. She was just like, I need you. Like, not only should you get in this business, I actually need you. So I jumped right in, and I think the first month I had 10 loans. I mean, it was a big deal. Like, I went from not knowing anything to having 10 deals land in my lap, which is a big volume.
I can't imagine any better way to learn though.
Oh yeah, it was
trial by fire.
Jump in the fire for sure. Yeah.
That's great. So I'm sure that's when the FedEx company probably trickled off after you got busy with all those loans.
It's funny. So the FedEx thing, it was a home delivery route. They made you feel like you owned your own business, but they were telling everyone what to do. It was like, the tread on these tires is a little bit thin. You got to go buy new tires. So it was kind of like
you bought a job.
You bought a job, really, pretty much.
Okay.
And they were just saving a bunch of money in payroll taxes is all they were really doing.
Sure.
They were like, oh, these guys are all subcontractors.
See, you learned something from that, though.
Oh man, yeah.
Yeah. I like that.
Yeah,
okay.
they basically came to me and said, you know what, I think you're going to have to fire your employee. And I was like, well, I don't think I have as much control over this as I think I do.
Yeah. Okay, so it sounds like you had a lot of influence from family and friends growing up.
For sure.
Not to take for granted, you definitely learned your own lessons along the way by taking that action. What kind of role would you say they played in the success that you've seen today?
Oh, it was big. I mean, growing up, like I said, I originally wanted to go to med school. My dad was an orthopedic surgeon, so there was some influence there.
Yeah.
He actually was buying real estate pretty early, and so that was like my first kind of insight to like, oh, this might be a good track some point down in my life to own some property.
Yeah.
And then of course my brother, he was already in the industry, my sister-in-law. And so, it was very much, I attribute everything that where I am today to like, it just landed, right? It was just like, I do have to make the decision of whether I want to do this or not. And should I take action or should I not? But I mean, let's face it, I'm lucky to be born where I was born, in the family that I was born, and have the opportunities that I had. So,
yeah, it's amazing. And I hear this often is that it doesn't come down to your IQ. It doesn't come down to how hard you work. What it mostly comes down to is your zip code.
Right. Yeah. No, I mean, we're all really lucky. I mean, we can start with you just being born in the U.S., right?
Sure. 100%.
Right. Yeah.
I think the top 1% earners in the world, their average annual income is like $36,000. Don't quote me on that. It's not exactly perfect, but it's something insignificantly lower than what you think it would be.
Yeah. I mean, the opportunity is incredible. Yeah.
Yeah. You also mentioned books.
Yeah.
You have to educate yourself in some fashion, form, or way. I mean, you went to college, obviously.
Right.
So how did you take the college education and transform your education? Now I got to learn about mortgages, interest rates, lending.
Yeah.
practices thereof?
Yeah, good question. So, I mean, on the book side of things, the first couple books, well, I won't talk about the mortgage piece quite yet, but
Sure.
kind of my mindset of like, okay, I need to start learning more than the psychology, biology, world, and Spanish. I actually took a bunch of Spanish in college, but I read the book Rich Dad Poor Dad. That was like my first book that I was like, okay, that was my first business book, I think. And honestly, I don't know who talked me into reading that book. And there's probably someone watching that's like, I told you to read that book. Right? You don't remember that?
Right.
So I got to apologize. And I don't know if it was my dad or who it was, or maybe one of my older brothers. But
Thank goodness they did.
I read that book, and that kind of changed my mindset quite a bit.
Yes.
That's where the whole passive income and real estate kind of entered a little more concretely in my brain.
I have to tell people, for me, because that book drastically changed my life.
Yeah.
It recalibrated my brain to think differently.
Yep.
Sometimes us as men, especially in our younger years, nobody can tell us anything.
Right.
But that book,
Yep.
that I was like, whoa, it changed things.
It was an eye opener for me too. And then the next book I read,
Yes, I'm glad you're going to talk about this.
the
I wanna talk about
second
it too,
book
yeah.
that was like really changed things for me. And this is right when I started to get into the rafting world.
Okay.
And running that business was the E-Myth. I don't know if you've read the E-Myth.
Yep, the E-Myth and the E-Myth Revisited.
Yep. And so that was kind of my next one that I really loved.
Yeah.
Because I was like, okay, I know how to row a boat. I know how to run rivers. I know how to cook meals for people. Our trips are 6-day trips. And so we're in the wilderness and we're doing all these tasks, right? We're very task driven. And it's like, it's been so long since I read the book, but I've forgotten each role, but you have the person that's good at that job. And then it's like, are you good at that job? And now you want to run this company? Like, you think you can do all these other roles. And so that was a really, really good one for me to like really, really just put my mindset of like, okay, now I'm putting on a different hat. Sorry, I'm bumping the mic here. Now I'm putting on a different hat as a manager or an owner or a leader, those sorts of things. So
Yeah. For me, when it comes to books and where I got my recommendations on where to read those or why I should read these, I got a lot of my recommendations, especially Rich Dad Poor Dad, was from podcasts like this. Mm-hmm. You and I both have spent thousands of hours listening or reading to books.
Right.
And we have our favorites, the ones that have impacted us the most.
Yep.
And me personally, when I first got started off, I was like, okay, well, if this person who is this successful says that this book changed his life, then it has to do something for me too.
for sure.
I just have to implement it.
Yep.
Yeah.
Yep.
Love that. Okay, so let's talk about, you got into, I know we're kind of skipping past, your mortgage phase, but at some point you took your active day job income and tried to make a passive into holding real estate. For you, I know that was a couple years back. What did that look like to you? How did you start, finally purchasing real estate yourself?
Yeah. So I actually had my first purchase of real estate was just a house in the North End in Boise with a buddy of mine. So a friend of mine, he and I went in together on this house, which honestly, like I'm telling people today as a mortgage advisor, I'm like, everyone, when it was 3%, people could buy houses on their own. And I'm like, look, you got to go back to buying a house with someone. If you're 21 years old or 22 years old and you want to get into it, find a friend, find someone that you can invest with. And so anyway, I bought this house with a buddy of mine. That was our first house. And my wife now, but girlfriend at the time, she owned her own house. And so we had, I had partial ownership of this house. She owned this house. And then my buddy left and she moved in with me, and we actually just decided immediately that's going to be a rental, right? So we started renting her house, and we hadn't had kids yet. We were just, only a few years out of college. She's a little older than I am. She's like 4 years out at that point, or 5. And anyway, so we ended up buying my partner out, and my wife and I owned that house together, and then we had a rental. So we started out with property, and then we decided at one point, it was only 3 or 4 years later, we had a kid, and we decided we wanted to move to a bigger house and raise him in a different neighborhood. And so at this point, I'm kicking myself to this day that we sold her house. So
This is like 2004, maybe?
so in 2002, no, '04. It was '04.
Oh, okay.
Because our son was born in '04, and then we moved in '05. So it was in '05.
Perfect.
And so we sold her house, and I'm just still today, I'm just like, why did we do that? And then we sold that house, and we moved into another. So we basically sold 2 houses to buy what we thought was our dream home, and it was. I mean, we were there 15 years.
Sure.
And we raised our son in that next house. But man, I 100% know we could have made it and still lived in that house and held on to those other 2 houses. But at the time, we were looking at dollar signs and thinking, oh man, we can get X amount out of this house and we can put that into this new house. And it really made that mortgage payment super easy for us at that point. But I think I should have made our living a little more uncomfortable.
Most investors I talk to, their biggest regret is all the homes that they've sold.
Yeah.
I get that there's a time and place to trade your 4 greenhouses for 1 red hotel.
Right.
Totally understand that, especially if you're trying to take advantage of taxes. There's a time and a place for that. But the biggest regret that I have seen is, man, I wish I would have kept that house.
Yeah.
You're not alone.
So now we're down to just our single family residence with our family. We're enjoying everything. I'm in the mortgage business. And then a couple of years later, we have the whole mortgage meltdown. 2008 happens. We see this crash. I see our income go way down. My income, hers, fortunately, she was still working. And I can't even tell you how many investors that I know personally and people I'm doing loans for who were just losing houses, giving them back to the bank, foreclosure after foreclosure. I have a particular person I know that seriously had 7 foreclosures. Came back to me like 2-3 years later after he kind of had back on his feet. And we were still trying to just sort through foreclosure messes, trying to get him a new loan. So I witnessed that. And so during that time, I was a little scared. I was like, gosh, you know what? I'm not buying anything again. And I'm kind of glad I didn't have those. At that point, I was kind of thinking that. But fast forward today, 20 years later, I really wish I still had those. But to just go back to the mindset at that time was, okay, we have this rental and I'm going to continue to start buying houses, I think. Well, I put a total hold on that whole idea when the crash hit, because I was deep into it with the mortgage business. I was just watching so much happen. So we were lucky that we didn't take a big hit financially, other than just my everyday income. So that went down. But as far as like losing properties or losing tenants and having to give anything back personally, but it definitely delayed my next purchase, right?
I know there was a big time gap in between your next purchase.
Yeah.
What was it that made you decide to, okay, now I'm going to get back in? Because, you bought and sold your last house, let's say it was 2007, 2006?
Yeah, so 2006.
2006,
so we bought it
okay.
in 2006.
And then your next purchase didn't happen until around 21?
Yeah, 20.
20?
Yeah. So, I mean, a huge
gap.
I mean, I actually took this completely different mind shift for a bit. And, gosh, what was my influence? I'm trying to think. If there was a book or something. Like I totally shifted and said, I'm paying off my mortgage. Like I went into this whole other, I'm not leveraging anything. I'm paying everything off. I'm going to have 0 debt, which, in my mind.
Go full Dave Ramsey.
Yeah, that's what it was. And it wasn't him in particular, but there were other influences, and I can't remember where they were at the time. But it was just what I was witnessing at the time. I was like, I don't want any debt. But I just come from like, leverage everything you can, leverage it all and build and leverage and build and leverage and build, right? And I kind of had this shift of like, nope, not going to do that. And then what it was the next shift back to I need to leverage some and build again. The next shift was really just watching the real estate comeback. I mean, in 2010, 2011, 2012, I'm doing loans for all these people buying these houses, right? All these investors that are buying houses and friends and family. And I'm just watching prices rebound and rebound and rebound and rebound. And I'm just sitting there going, what am I doing? Like, why am I waiting? And I just waited way too long in my mind. Now I have some property, but it's not as much as I wish I had, right?
Sure.
And but it was that I was a little gun shy from the meltdown and what I saw happen to a lot of people during that time, and I just couldn't get my mindset shifted quite fast enough back to like, okay, you should have been buying 5 years ago.
With the market is where it's at right now, and you have been lived through intimately the 2008 crash.
Yeah.
What is your mindset now, knowing what you know, as you look to invest into the future?
Yeah, it's interesting. It's interesting because we get a lot of people. I get a lot of people who are like first-time home buyers or first-time investors that are like, we just want to wait. We just want to wait. And I don't blame them for thinking that way because of rates and where rates have gone over the last couple of years, right? But we get a lot of, I just want to wait. And I'm dead set on, we live in Idaho and we live in the Treasure Valley, and waiting just is not an option in my mind. It's like, you get in now, and I don't care what year it is. Like, we bought our house in 2006 and it was the peak.
Mm-hmm.
And then we watched it crash and we watched it go to nothing, but we watched it drop 30, 40, 50% almost or whatever. And then it all came back by the time we sold it. We moved again. So we moved just 3 years ago back into the North End area.
So would you say your biggest lesson learned is identifying market trends and realizing that the market will have its crashes and it will have its bull runs? So it doesn't matter. I'm not saying it doesn't matter, but it's more important to get in, to have time in the market than timing the market?
100%. Yeah. Yeah. I feel that way about real estate, just as the way all your stock advisors tell you about stock. It's like, don't try to time when you're buying
Sure.
it, right? You just get in.
Yeah.
You know, and it depends on your philosophy of what you're trying to do too, right? What are you like? If you're a house flipper, that doesn't necessarily make sense always, right? Because you are trying to time it. You are trying to a little bit, and I'm not a house flipper, but I just think about the short-term investors
versus the long term.
And for me, it's long-term. And everyone I talk to, mostly in my business, are first-time home buyers and other investors. Most of them are long-term. Most of those people are in for the long term. And I just tell everyone, if you're into the long-term, just look at this line. Like, it's going up.
This show would not be possible without the support from our local community. Because of you, we're able to share information from leading professionals like never before. That's why our sponsors at Boise Turnkey Investments and Your Stay B&B have teamed up with the Boise REIN Show. Whether you're just starting out or you're a seasoned pro, they help bring you all the insider information to get you started on your journey today. Back to the show. You are somebody who's been in the, we'll call it, high income earning W-2 job. You've had a successful career, you and your wife especially. What is it about real estate that made you decide to invest in versus just investing, like keep pumping into your IRAs or your 401ks?
Yeah, great question. Yeah, because my wife had a regular, pharmaceutical job, and we were pumping money into her 401k, right?
Yeah.
And I had a 401k with my business, and I just like real estate. Like I enjoy real estate. I like looking at it. I like houses, and then two, I wanted to diversify some. I didn't want to just be in the stock market. And I also kind of like having having my hand, in it. Like I like managing some properties. I like being involved as well. So I was looking for a passive, mostly I'm looking for passive income, but at the same time, I just do enjoy it too. I like property. So I kind of do a little both. Like, we have a triplex that we have a property manager completely run and manage. And then I have a couple single family residences, or we have a couple single family residencies that I actually run. And so those I kind of enjoy being part of. Triplex, I'm happy, is because there's 2 short-term rentals in there. I'm happy to let the property manager take that. But yeah, to answer that question a little more specifically, it was a little more diversification, wanting to be in real estate. And I think that the returns are huge and can be huge.
Can be huge. Let me ask it in a little different way. For those types of people who have those, high income earning jobs, they just want to be a W-2. What are some of the reasons why they should be investing in real estate as a different asset class?
Yeah.
To either add to their portfolio or diversify their portfolio from the average money market accounts.
Right. I mean, for me, it was going after more of a eventually passive income revenue stream. And so I think that's a big one for people. If you want some passive income, obviously 401ks and IRAs and those things will eventually they're going to be paying you, yearly.
But they're not realized.
But they're not realized, right? Yeah. Yeah. And it's a long ways down the road.
Yeah.
Like a long ways down the road.
You have a lot more control over your real estate portfolio than you do your IRA that you can't take out until you're 54 and a half or whatever the age is these days.
For sure. Yeah.
Okay.
Yeah.
Are you able can you speak a little on how you can leverage some of your like money market accounts? Because aren't there some like self-directed that you can either put in?
Yeah, there are some self-directed IRAs, right, that you can be buying real estate with. I actually don't personally have a self-directed IRA. My brother ended up getting one a few years ago, and so he does a little of that with his self-directed. He has some real estate investments in there. I think it's a great avenue for people to still be in real estate, but kind of looking at it from more of the long term, IRA perspective. But we don't do those. We don't do those loans. Sure. But so I don't have a lot of experience with it. But.
I'm just curious. Maybe you've had some clients that might have leveraged some of their accounts,
right?
Like either it be collateral or lines of credit against their money market accounts with the banks.
Yep. Yeah, so there's my brother does have one, and I know that one pretty intimately as far as what he's been doing with it, and it's been great. It's been great for him, and we have a property that we own commercially together, three of us, and when we take dividends, it goes straight into his IRA sort of stuff. But it's I think a great way to get into it because a lot of people will have some money there, right? You already have money and you can just redirect that money because that can be the first hurdle for some investors is, well, I don't have 20% down or 25% down to buy that property. Yeah. But they might have an IRA that does. Right. And so you can just move that into a self-directed.
A lot of people don't realize that they can even do that.
Right. Yeah.
Which is a great way to get in.
It really is. Yeah. No, I mean, because there are a lot of people that have plenty of money in their IRAs where they could do that.
Yeah.
Yeah.
Okay, so let's move the conversation into interest rates and lending in general.
Yeah.
Something a little more your forte. Just because 2012 was a good time to get into the market doesn't mean it was a good time to get a loan. Like I understand like, if I would have got in 2012, like I'd be rich, right? But in that time, everyone's fighting over lending. Mm-hmm. Like it's hard to get a loan. You'd spoken about that already. What are some of the strategies people can use to ensure that their loan is as good of a deal as the property they're purchasing?
Yeah, I mean that one is a little bit less in everyone's control, right?
Yeah. As
far as like, okay, where do I go and how do I find the right lending source or the right, it's the whole rates. Where are rates today, and what avenue are you going to take to purchase, right? And so. What we do, 90 or 80% of the loans, I think it's 70 actually, 70% of the loans that are written today go to Fannie Mae and Freddie Mac. And so that's 70%. And then there's jumbo loans that don't go to Fannie Mae and Freddie Mac. And so, which are still kind of considered conventional loans, like all the documentation, everything else. So it's about 80% or so are going to be your cookie cutter style loans, and the rates are the rates based on the market, right? And then beyond that, you can get into your non-qualified mortgage, your non-QM loans, your hard money loans, creative finance, all these other things, right? And so as a consumer, your hands are tied a little bit to what's happening in the market and not a little bit, a lot, right? And so it really comes down to where are rates now and why are they doing what they're doing? But I still tell people I don't think it makes sense to try to time it, right?
Sure.
Yeah.
I know there's a few other avenues that we can adjust the rate a little bit, either being good credit,
Yeah.
ARMs maybe, for example,
Right.
buying down the loan, or maybe just having a good relationship with your lender, because sometimes closing is more important than getting a good rate.
For sure. Absolutely. Yeah, no, those are good things that you hit on. Buying down the rate is a huge one. A lot of people
When
buy
would it
down the
make
rate.
sense to buy down a rate?
That's a great question. I'm doing those numbers every day with people. I'm looking, because right now we have scenarios where builders are giving $20,000 credit to be used to anything. And some people, I'll say, okay, well, if we buy down the rate, this is what it looks like. And I just do the hard math with them. If you use that to buy down the rate, then this is what your rate would be. And if you use it for upgrades, then obviously your payment's going to be more. But it's just looking at that math. But buying down the rate is one good way to get that payment down lower. And using a credit from the seller is a great way to do it, right? If you don't have money out of your pocket. And then the other piece, like you said, so thanks for saying that, credit scores are huge. And I would say credit scores are bigger now than I can remember them ever being. Just in the last, 5 to 10 years, there's a real big difference between a 600 credit score and a 750 credit score. And it's not just in rate. So we have these adjustments in rate that are called loan level price adjustments. And so those loan level price adjustments are things like, how much are you putting down on the loan? If you're putting less down, then there's a bump. Do you have a 750 credit score or 600? If it's 600, there's a huge jump in the rate. And those price adjustments are for all these little things. And so the more money you put down, usually the rate's going to be better. The better credit score you have, your rate's going to be better. And those are the two biggest pieces, really: down payment and what your credit score is. But buying down has become a real thing in the last few years because of higher rates recently.
It seems like ARMs have kind of not been a thing for a while now.
Yeah.
Why would somebody, and for those listening, it's an adjustable rate mortgage.
Yep.
When would it make sense to maybe think of considering something like that?
Yeah, great question. You mentioned ARM a second ago, and I didn't address that at all. So when I first got in the business, we were doing tons of ARMs. And in the last 5 to 10 years, I haven't sold a single ARM. And I won't say a single ARM, sorry. We were doing ARMs and being able to sell them to Fannie Mae and Freddie Mac, and those all disappeared. The only ARMs I'm doing now actually are higher rates than our standard stuff because they are out of the box. They're on our portfolio side. And so our portfolio side has ARMs, but they're higher rates. And historically, it was, just get an ARM because it has a lower rate, right? And
historically, yes.
Yeah, historically, that was the mindset.
Yep.
It was like, well, if you don't do a 30-year fix, you can get in with an ARM and get a lower rate. There are some banks that are still doing that, and there aren't a lot of them. But like as a mortgage bank, when we're selling a lot of this to Fannie and Freddie, they don't even exist. Like investors, and the reason they don't exist is investors are not buying them. Large pool investors are not buying ARMs for the most part. And so to get an ARM, it's usually going to be an off bank that still offers one because they're going to portfolio it. And our portfolio is a different thing. Our portfolio is higher risk loans. And so ours are a little bit higher. So I get people who are used to buying property from years ago, and they're like, well, tell me what a 5.6 ARM is or a 5.1 ARM is today. And my answer is, I can't even offer it to you today. Like, we don't even have it. I mean, aside from the portfolio ARM that we have, but of course they don't want that because I know what they're asking for. They're asking for the lower rate.
Right.
Yeah, because they're like, well, I know I'm not going to be here more than 5 years, so why wouldn't I just do that? And it's a good point. Back in the day, we were doing them all the time because people were like, hey, I won't be in this property that long. But the market has literally just disappeared. Like the 5-year ARMs really don't exist for the most part, other than some banks here and there that will do them.
Sure.
But the broader lending world, people that are selling Fannie and Freddie mostly, they're not out there.
You keep saying Fannie Freddie, and some people know what that means. Can you elaborate? What does Fannie, what does Freddie mean exactly?
Yeah,
because it's a term that gets thrown around a lot.
It does.
And everybody just says it because that's what everybody else says. Can you explain for sure what those are?
I'll explain it. Yep. So Fannie Mae and Freddie Mac are the two they're government-backed entities. They're not owned by the government, but they're government-backed. And they basically started, I think they started back in the 70s. Their whole purpose is to buy loans from banks to make banks, give the banks the ability to continue to lend. And so there are these huge agencies that have set, for the most part, the guidelines for how we do loans, because like I said earlier, 70 to 80% are based on these guidelines. And then we're a mortgage bank. And so most of what we sell will go to Fannie and Freddie. And even the local banks are going to be selling their stuff to Fannie and Freddie for the most part, because they want to offload that so they can release their money to be able to lend more. So it was a brilliant way to get home ownership to the broader American people, because it freed up capital that banks were, if they're lending their money out, now they
only have so much.
They only have so much. And they can now sell that and then keep lending. And so it's been huge for everyone in the U.S.
What's in it for Fannie and Freddie? Or actually, let me back up. What's the difference between Fannie Mae and Freddie Mac?
They're very, very similar. And honestly, I don't know why there's a difference between those two.
Right.
Like historically, their guidelines are almost identical. There's some nuances here and there between the two. There are some days where I'm pricing something that's Fannie Mae, and I just look at our rate sheets and I'm like, this is better on Fannie today, or this is better on Freddie today. And then we'll lock it, and we actually have our own underwriting. We do all of that, and then we'll deliver it based on how we locked it. And that's just flat out mostly because of a rate. One's being a little bit more aggressive than the other sometimes.
I want to talk about different types of conventional loans that we can get.
Yeah.
So, or what options are available to the people out there? So, like the ones I'm familiar with, like VA home loans, conventional, FHA. Sometimes you have some state-funded programs.
Right.
We've got the new one for multifamily. So maybe you can elaborate a little about something that I'm missing, or just the options available for people.
Yeah. Great question. So, so the main ones, obviously, the Fannie Freddie loans, conventional conforming stuff. FHA, like you said, VA.
FHA being federal housing
agency. Yeah.
Okay.
Yeah. FHA, and FHA has kind of become, back when I got in the business, there were a lot of what we called subprime lending that was going on, and the subprime lending was all basically going to Wall Street. And when that went away, that was kind of the lower credit scores and all the crazy stuff that was happening. When that went away, FHA kind of became the new low credit score avenue. But FHA is a great program. It's just a little bit more expensive, but you can get approved easier on FHA if you have higher debt to income ratios and things. So FHA, VA, conventional, we have jumbo loans. That are anything over 766,250 is the number today, and that number
is that nationwide?
No, it's based on county, but mostly nationwide. Like there are some counties, like Blaine County is a little higher, King County in Seattle is a little higher. So there are all these counties that have some higher abilities to lend in some of those counties, but for the most part, it's 766. That's the conventional, and then we have RD loans, so rural development. So those are USDA loans, and those aren't used that often. You have to the property itself has to qualify in a more rural area, and so there's just a rural map that you go to and you look at it to see whether it's going to qualify for RD. And then we have this whole portfolio side that has bank statement loans, and we have bridge loans, and we have fix and flip loans, and we have DSCR loans. And so those are all in this, what we call non-QM space, non-qualified mortgage. And the qualified mortgage term originated out of Dodd-Frank. So when the mortgage meltdown happened, Dodd-Frank came in. They became the new regulatory, that was the legislation, and the CFPB became the new regulatory arm to manage the whole mortgage world and banking world. And so a term came out during that time called the qualified mortgage. And basically, a qualified mortgage is going to be deliverable to Fannie Mae and Freddie Mac. And if it has terms outside of what Fannie Mae and Freddie Mac deem acceptable for their guidelines, then it becomes a non-qualified loan. And so things like DSCR, fix and flips, bridge loans, all these things I was just mentioning, that all lands in this non-qualified mortgage world. And we have a whole portfolio department that lends in that space. And that includes new construction too. We have new construction that's in that world. And so those are some other avenues for lending, right? The DSCR loan, which debt service cost ratio is what that stands for. And that's a big one for investors because it doesn't take into consideration the investor's personal income.
Just the asset.
Just the asset, yep. And how that property performs from a debt service perspective. Yep.
All right, I want to get into the weeds a little more on this so people understand what options they have available and what prices. So I'll ask specifics, but let's just get into it. So qualifying mortgages, VA, for example, 0% down, correct?
Yep.
But you have to be a veteran to apply for those, right?
Correct. Yep.
Okay. A conforming Fannie Mae, Freddie Mac. I'm going to buy a personal residence home. How much down am I putting down? How much money am I putting down?
You can go as low as 3%.
Okay.
Yep. And FHA requires 3.5%.
Okay.
Yep. So if you're a first-time home buyer on a conventional stuff, you can get as low as 3%. So you can get actually even lower than FHA. A lot of people get that confused. They think FHA is the lowest option. And
the new multifamily, is that also a qualifying mortgage?
So it's not. So the multifamily, we aren't doing are you talking
that 5% down on a 4-unit and below?
Yeah. So we don't even offer that loan at this point. Yeah.
Can we get it? Is it offered out? Who do you get it through?
I honestly don't know the answer to that.
Okay. No, that's fine.
Yeah.
And I know it's a new thing. It's
a
brand new thing that legislation just came down with, right? Or something like that.
And I don't even know, unfortunately. I can't speak intelligently about it. I wish I could.
Sure. So let's get into some of the non-qualifying. I know you mentioned a few. So let's take DSCR for example.
Yeah.
You mentioned that's a good opportunity for investors to purchase an asset or an income producing asset.
Yeah.
There's some others like bridge loan. Can you go into bridge loan a little bit?
Yeah. So our bridge loans we use. The bridge can be used for a number of different things. Most people use the bridge if they are selling a house and going to buy a new house, and they don't want to sell this house yet, and they can't qualify. And so it becomes a bridge to get them into the new house and then give them the ability to sell this house, and then they can use that equity later. So that's what the bridge is used for most of the time, but we can use bridge for also things like income, where let's say someone's only been self-employed for a year and a half, and let's say our guidelines are asking for 2 years self-employment. There are times when it only asks for 1 year, but for the most part, most people think of it as you need to be self-employed for 2 years, and that just comes down to individual bases, but and what the guidelines spit out to us. But if the person needs 2 years and they don't have 2 years, and we can see that their income is solid, and we can look at their profit and loss for this year, then our company, and it becomes a case-by-case basis. Our company will look at it and be like, oh, we can do a bridge loan, and our bridge loans are 12 months. And so you have 12 months to have an exit strategy from that. And so what I would do in that instance is I would go to our company and say, look, okay, we have this perfect client. He's only been self-employed for a year and a half, makes good money. We can't document it and send this loan to Fannie or Freddie. We have no other avenues. Let's do a bridge loan. We'll give them the bridge. They can get into this property and they can buy this house. And then, once the year's up and they can file their tax return, then we can document the 2 years and do a refinance. And so the bridge loan can be used for a number of different things, but most of the time it's used for the departing a residence and don't want to sell it first and want to get into the new one.
Sure.
But it can also be used for purchase. We do a cross-collateral loan where you can cross-collateralize other properties. And so this can be handy for investors sometimes, because if you have investors that own real estate and have a lot of equity, then we can actually cross-collateralize properties to get them into other properties, because we end up putting 2 loans on them, and that can be the bridge as well, and come up with an avenue to take that out within 12 months. So the bridge is a 12-month short-term deal.
I have more questions, but I just want to say this is why it's so important to find yourself a good lender. Someone who's going to join your team, be a rock star member on your team, and just try to find a win-win for everybody.
Right.
Because that's so much good information.
It's the fun part about this business for me. I love scenarios and solving problems, right? And just helping people figure this out.
Okay, so bank statement loans. How does that work?
Yeah. So same thing. We had recently a guy who owned his own business, and startup costs were crushing his numbers on taxes, right? But he was making some good money, and so we could prove it with bank statements. We could say, okay, look at the last
monthly.
Yep. We look at the last 12 months. Sometimes it's 24.
Okay.
Sometimes you have to go 24. Sometimes you can go 12, depending on the scenario. But in the example I'm thinking about recently that we did, it was the 12-month bank statements, and then we showed them where his current profit and loss was. But you just go off the income that's showing in those last 12 months, and you can use that. And we can actually use we can give people income for assets as well, as far as like stock accounts. You can annualize some of that income and use that at times when people have dividend income and that sort of thing. So there's all sorts of avenues.
Yeah, you guys count everything.
Yeah.
What about business credit? Can you loan against business credit?
Give me an example of what you're referring to.
So let's say somebody doesn't have let's just say somebody went out and tried to apply for mortgages and did a lot of hard, help me with the phrase I'm looking for.
Hard money?
No. Hard pull on their credit.
Oh yeah.
And then it just shot their credit way down.
Okay.
And they're like a 640 right now.
Yeah.
Might be no fault of their own. They just didn't know what they were doing at the time, but they ruined their credit. They still need to buy a house. They own a business. The business has built credit. Can they lend on their business credit versus their personal credit?
Good question. Okay, we cannot. So yeah, in all of what we're doing, it's going to be in the individual's name. So most of these, on the portfolio side, I have to kind of differentiate this,
okay.
Right? On the portfolio side, we can do some more out of the box stuff, and we can lend to like LLCs. But on the residential conventional side of your standard loans, right? Fannie Mae, Freddie Mac, FHA, all those. You cannot. You have to use personal credit and get them qualified based on their personal.
Okay. Yeah. You were saying on the portfolio side, though, there's some more avenues you can work with.
Right.
Let's get on the portfolio side.
Yeah, the portfolio side it's very case by case, and it's very much like, show me the strength of this person. Where are the strengths? And then so we'll look at that, and someone might have a lot of property, and not a lot of income, or a lot of assets where they can buy, put a lot of money down necessarily. Someone might have strong credit scores, but their income is messed up for a number of reasons or whatever. So it's really taking that individual person and looking at it case by case and saying, okay, what can we do here? And then we would go to our portfolio department and say, okay, this is what we're hoping to do with this client and why. So it's very case by case. So it's kind of hard there isn't like a cheat sheet, something that I can walk in and hand it to someone and say, we do these. You know what I mean? So I just get a lot of agents and a lot of clients that are just like, call Grant. He'll talk you through and help you figure it out. And sometimes, like in these bridge loan scenarios, that's a portfolio loan, someone will send me a client that says they need a bridge loan, and I'll start talking to them, and I'll look at everything, and I'll say, actually, I can't do a home equity line of credit because we don't offer it, but I will send them to a bank that I use locally. There's a private banker that I know, and I'll say, hey, we take care of them, give them a home equity line of credit so they can buy this property. And then I'm not even involved. And so really it comes down to just tell them to call Grant, and then they'll figure it out and figure out an avenue, even if it's like helping someone else, just get the loan somewhere else and I'm not getting paid on it, which is great. I love just helping people figure out the solution.
Help me understand more of your portfolio lending platform. Are you using that as a term of, hey, this is an area of our company that we can work outside of the box? I know you said it's case-by-case basis, but what would be some of the qualifying factors? Like this person, like you said, has a lot of properties, or are we going to pull these in like under an umbrella? Like explain a little more what that means to use your portfolio lending platform.
Yeah. It's a good question, and it's really hard to kind of nail it down.
Sure.
Other than, for the most part, it's the non-qualified mortgage out of the box scenarios. And sometimes people don't even know they're out of the box, right? I mean, someone comes to me and they're like, I want to get a loan on this. And then we start looking at the file and we're like, well, we can't, you're out of the box. But we can look at it from this out of the box side. So I don't know that there's something I could say that someone would be like, oh, that's me, right?
Sure.
Unless it's real obvious, like you've only been in business a year or a year and a half.
Mm-hmm.
Those sorts of things are, I would say that's the biggest piece of out of the box that happens with our portfolio side is an income hurdle, and usually due to tax returns.
Are there any other creative avenues that I might be forgetting or that you can think of other than the ones we just talked about?
You know what? So I just got this class approved through Idaho IREC, so the Real Estate Commission. So I teach a 2-hour class now on out-of-the-box lending, and it's all this portfolio stuff that we're talking about, the non-QM stuff, the bridge loans, the DSCR, all these things that kind of we have access to in our portfolio side. But there's a whole nother arm, and this was the end of this class that I had to bring up this slide that said creative financing, right? Because creative financing is a whole nother world in itself. And this network knows a lot about creative financing. In fact, I've been coming to meetups and things to learn more about the creative financing side of things. Bigger pockets, there's a lot of talk about creative financing there, right?
Yep.
And so that's a whole nother world that I'm not as familiar with because I'm not dealing with it as much. Other than personally, I actually I did a sub-2 deal not too long ago personally myself. But we don't offer the creative financing side. And it's funny because some people will say, well, what you're doing with the non-QM is creative. And I'm like, it's creative, but it's not creative financing. In my mind, creative financing is a thing, right?
I call it creative lending.
Yeah.
What you do.
Yeah.
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 And I think that is definitely a thing.
Right.
Like you said, you just did the subject to the mortgage,
Yep.
which is 100% creative because you had to come up with the terms of the deal, right?
Totally.
Yeah.
Yep. And so, that's a whole nother world that I just got into personally.
Yeah.
But I don't know a lot about it.
Sure.
Other than my own personal deal.
Either way, it sounds like if somebody out there is having an issue or they hit a roadblock that they can't quite figure out, what I've learned is just call Grant.
That's a great source. I'm a great source for that. And then if we get into the creative financing world, I'm going to say, let's bring in all of our friends here at this network.
Yeah, definitely.
Because there's so many people that know a lot more than I do about the creative financing side.
Something you do know a lot about, though, from what I'm told, is interest rates.
Well, I know a little bit.
You know a little bit?
I've got to know a little bit.
I know a little bit, too. And I try to educate myself as best I can, and I suck at it.
Right.
The way I understand it, because we talked about this earlier, is the government sets the standard. They set the legislation, what they want it to be at based on the economy, because they want the economy to either grow, shrink, inflate.
Mm-hmm.
I don't know. And then from the government, they use the Federal Reserve to implement this. That's where all the money comes from. And then you have your banks that follow the Federal Reserve's guidelines, and then you have the lenders that lend from the banks, and then from there you have the homeowners that get with the lenders.
Right.
Is that Did I explain that right?
Well, you
Probably not.
explain these avenues that happen,
Okay.
but it's not how rates are determined.
Okay.
So
Please enlighten me.
So you got part of it, right? But actual rates themselves, it's just like the stock market every day. Like there's a mortgage-backed securities market that is moving up and down. So a lot of people look at the 10-year Treasury. When they're looking at rates, they're like, okay, the 10-year Treasury is doing this. And the 10-year Treasury isn't mortgage rates either, but they follow really closely together. And so a lot of people will follow the 10-year Treasury. That's the easiest thing to follow because some people, you don't even get access to mortgage-backed securities, just like unless you're part of a website or you know where to go, right? So I belong to a website that they talk about it every day, and I'm watching mortgage-backed securities themselves. And so they're trading on the open market. And so the open market is technically, the open market is determining what the rates are, but the government can have a huge influence. And so what you alluded to earlier of the government setting, the standards or rates. So when people talk about the Fed and the Fed is going to raise rates, that gets confused with what mortgage rates are doing. So when the Fed is raising or lowering rates, they're raising and lowering the Fed funds rate. And so the Fed funds rate is for the banks. And that's it's like the overnight rates that banks will borrow money from each other, and that's the rate that's set where they're borrowing from one another. And so that's separate from mortgage rates. It has an impact on mortgage rates, right? But it is separate. And so the open market is really determining where rates are until the government starts to do things like buy mortgage-backed securities and treasuries. And so when we saw rates go to 3%, it was primarily because the government was pumping and buying tons of mortgage-backed securities. So they were buying it all, and it was bringing the rates down.
That's how they pump the money into the economy.
Yes.
I see. Okay.
So they were spending so much money, and that was the demand. It was they were buying it. And so the supply was going down and the rates were going down. And then when the government stopped buying it and just said, okay, we need to stop meddling with rates, then it started to correct. And then now we're back to where we are, right? Now we're in more of a natural environment now than we were before. And so to be down in the threes is like, unless the government comes in and starts buying, or someone else is buying massive amounts of mortgage-backed securities, it won't likely get there again. I mean, I'm not going to say it won't, but that was artificial, right? It was artificial. And so that's what's really determining what the rates are.
Okay. I learned so much. Thank you. Yeah. And I didn't know that's how the Fed, I don't know if I want to call it the government or the Federal Reserve because they're two different entities, on how they pump money into the market. They do it by buying treasuries. Buying and selling treasuries. Okay.
Yeah. And here's a big thing. I usually tell people when the stock, and it's not always this way, but when the stock market's going up, usually that's bad for rates. Usually mortgage rates are also getting worse. When the bond market, so usually stocks and bonds move separate from one another, typically, right? Stocks are going up, bonds are going down. And mortgage rates usually follow the bond market. So they're usually doing what the bond market is doing. And so typically when the economy is doing poorly, that's good for us in the mortgage world because bonds start to do better. So when the economy is doing poorly and stocks are going down, bonds are going up and doing better, and that's when rates go lower and they do better. And so I usually just tell people that's the best way to just kind of know generally what's happening, but it's not always going to follow that. But it's for the most part, it's doing what bonds are doing.
Sure. I wanted to ask this question earlier, and it has to do with the banks. What do banks do with their non-performing notes? Because if the banks are selling them, right? You said they were selling them to Fannie Mae, Freddie Mac.
Yeah, so the banks are selling all of that. So the Fannie Mae and Freddie Mac are the investor behind that, right? And then there's the servicing side, right? And so then the servicer is different from the ultimate purchaser of the loan.
Okay.
And so, like Wells Fargo, we'll just take Wells Fargo for example. They might sell the loan to Fannie and Freddie to get it off their books, but they might hold the servicing.
Okay.
And so there's money in doing that as well.
Right, because they want the interest rate. Right?
Yeah, and so the interest rate typically is going to investors too.
Okay.
But there's a piece that I don't even understand that where servicers are making money.
Sure.
And it's built all into that, right? There's some money's going to the investors, some money's going to servicers. So basically, investors are paying the servicers to service it because they don't want to deal with people.
Sure.
Right. And so there's that servicing side, and the non-performing stuff, I don't know anything about.
Fair enough.
I have no idea.
I just imagine
works.
banks are going to have good performing notes and bad performing notes. And on their rap sheet at the end of the month, when they report to the FDIC or whatever it is, like I'm sure they want to offload some of those non-performing.
Well, and for the most part, they have already offloaded it.
Okay.
And when they sell it to Fannie or Freddie, boom, gone.
Gotcha.
Yeah.
Okay.
Yeah.
Cool.
Hi, I'm Jonna Weber, the founder of the Boise Real Estate Investor Network. Thanks for being a listener of our Boise REIN Show, where our incredible pro members share their personal stories and areas of expertise with our listeners. If you're enjoying our show, you are going to love our Boise REIN community. Our mission is to inspire, connect, and equip you to create wealth and freedom for yourself and your family. We invite you to join us as a member at Boise REIN today at boiserein.com.
Anything else I'm missing?
Boy, I don't know. We've covered a lot.
We covered a lot, Grant, and I really appreciate it because I learned more in this 1 hour session than I have in a long time, and I look forward to more conversations like this. Thank you for coming in.
Yeah,
because that was incredible.
For sure.
But I do have one more question.
Yep.
In your opinion, what is, or from what you've seen, you've been in the industry for a while, what's one actionable item step our listeners can take today that'll get them closer to their goals tomorrow?
Great question. Great question. And honestly, like I thought about this, and part of it comes back to what I said earlier, which was I kicked myself for sitting there on the sidelines for so long, right? And so for me, it's take action. Like you just need to take action, and ultimately, taking action is not easy, right? It's not always an easy thing. So what I'm telling people is, look, you're not always going to feel comfortable. You're not going to feel safe. You're going to feel like you're sticking your neck out there. It's going to be scary. All those things, right, that stop you from taking action. And I always tell people, you're not always going to feel ready. Like you can't wait until like, okay, now I'm ready. Like you're going to feel uncomfortable. And someone's going to feel ready, right? Some people, but I think a lot of people are like, that's why they're not taking action and they're not taking that next step. And you just have to be able to live with the fact that you're going to maybe have to be uncomfortable for a minute and just go for it.
There's no such thing as the perfect time to buy. There's no such thing as the perfect deal.
Yeah.
It doesn't exist. Like we were talking about earlier, 2012, prices are way down. Looking back on it, that'd be a great time to buy.
Right.
Okay, but if you were living in 2012 trying to buy, now it's like, well, I'm not going to buy because interest rates are so high. Right. So there's never a perfect time.
Totally. And we're all of us are talking ourselves out of it a lot. You know what I mean?
Always.
So it's just like you just got to jump in.
You do.
You got to take action. You got to do your homework, but you got to take action.
Yeah, absolutely. Don't go in willy-nilly because the calm sea never made any good sailors.
Right.
Yeah. So Grant, thank you so much. If people want to reach out to you and learn more about what you have going on, how would they get a hold of you?
Just if you Google Grant Porter, Bluebird Home Loans,
Nice.
you're going to find me.
Yeah. And we'll have everything in the description below for everybody. So Grant, thanks again for coming in.
Yeah, thanks.
It certainly has been a pleasure.
It's been awesome.
And this is the Boise REIN Show. We appreciate you guys coming on and enjoying this time with us. If you like this kind of content, give us a thumbs up. If you want to see more, feel free to subscribe so you won't miss another episode. And hopefully we'll catch you guys on the next one.